Welcome to the Bounce Method podcast, where we don't just flip properties, we flip mindsets. I'm JD Allen, Marine Corps veteran, engineering leader, and your multifamily investment mentor. If you're stuck chasing small gains, we're here to change the game. Each week, we'll dive into strategies to buy, operate, upgrade, normalize, cash flow, and exit. That's right, bounce your way to your first million. No fluff, no hype, just real talk, real deals, and real momentum. So buckle up, it's time to bounce. Imagine walking into a deal knowing you've paid the right price. A price that virtually guarantees solid cash flow and upside rather than headaches and regret. For an early stage investor focusing on Class C properties in a tertiary market, mastering the art of buying at the right price is the foundation of your success. It means more profit, less risk, and peace of mind from day one. And in this session, the B in our bounce method, buying at the right price, will show you how focusing on actual numbers, not wishful projections, puts you on the fast track to financial wins. By the end, you'll know exactly what pitfalls to avoid and how to overcome 3 to 5 common scenarios that trip up new investors. Stick with us. This is where your competitive edge begins. Let's start with the golden rule. We don't buy on pro formas. We buy on actuals. Now, what does this mean? Actuals are the real historical financial numbers of a property. The rents actually collected, the expenses actually paid, the occupancy that actually exists. Pro forma numbers, on the other hand, are essentially predictions or forecasts. Often the sellers or brokers' best case scenarios of future performance. As one real estate guide bluntly puts it, a pro forma is inherently speculative. It tells a story about what could happen, not what actually has happened. In other words, pro formas are optimistic guesses, prepared to show the deal in the best possible light and should be viewed as a starting point, not as a source of absolute truth. Now, why is this distinction so critical, especially when we're talking about value-add deals in a Class C property? Because if you pay for a property based on hope for future performance, you are essentially handing the seller money for results you still have yet to achieve yourself. An experienced investor said it best. You don't want to pay on the pro forma because you'd be paying someone else now for something you would have to put in work to achieve down the line. Ouch, that's a one-way ticket to overpaying. Let's illustrate it with a jaw-dropping example. Let's say an investor found a small apartment building listed for $400,000, with the broker claiming it's worth that if it had a pro forma NOI of $29,000 at a 7.36 cap. The catch, the actual NOI was only about $12,000 for the past year. At a 7.36 cap, $12,000 of NOI supports a value much closer to $163,000 for the past year. In its current state, the building wasn't making any money, but the seller wanted a price as if it was already a cash cow. This is the pro forma trap in action. And if you fell for it, you ended up paying $400,000, you would be deep in the hole, banking on dramatic rent increases or cost cuts just to justify the price. Don't do that to yourself. So what's the right approach? Base your offer on actuals, what the property is doing today, and treat any future upside as your reward, not the seller's. Now, in real life, you might strike a balance, especially if the property is clearly under market rent and you have a solid plan to improve it. But your baseline is always the current reality. Remember, the actual financials equal facts, whereas pro formas equal hope and hypotheticals. A pro forma can be a useful tool to imagine a property's future value, but you must verify every number and remain skeptical of overly sunny projections. If the pro forma assumes you'll magically cut expenses in half or raise rents 50% in a year, challenge that. And as a savvy investor, you'll say, show me the actual trailing 12 months income and expenses because that's what I'm buying. Next, let's clear up a huge point of confusion for many newbies. Valuing a multifamily property is not the same as valuing a single-family home. In residential real estate, typically 1 to 4 units, the primary way to determine value is from comparable sales approach. Basically, what similar properties or comps have sold for recently. Your neighbor's 3-bed house sold for $300K, so your similar house might be around $300K, regardless of how much rent it brings in. Emotion and homeowner demand drive the prices there. Multifamily, 5+ units, or even 5+ considered commercial, however, is valued by the income approach. What income does the property generate? Lenders and appraisers look at the NOI and apply a market cap rate to find value. They do still consider sales of other apartment buildings, but mainly to gauge what cap rates and income multiples the market is expecting. So here's a quick rule of thumb as an expert investor. Anything 4 units or less is considered residential and usually will use a standard sales method. However, if it's 5 units or more, that's considered commercial and it'll be appraised with the income approach. Comparable sales will still be looked at, but the main driver is market cap rate to apply the NOI. Translation, if you're buying a triplex or a fourplex, the price might be heavily influenced by local sales comps, just like a house. But if you're buying a 10-unit apartment, the price must make sense relative to the income that it's actually producing. One more thing to consider. What you absolutely do not want to do is get it in your head that if the property down the street was a 10-unit and it sold for $1 million, that your 10 units should also sell for $1 million. It all depends on what the actual value is based on the NOI. In other words, comps may inform you, but your income is actually going to drive the value. Keep this in mind, especially in a tertiary market, where there may be very few comparable sales or any sales at all, making it even more critical to lean on the actual numbers. Now let's take a moment to look at 5 real-world scenarios that early investors often face and how we can tackle them. Scenario number 1, the rosy pro forma trap. This deal looks amazing on paper. A broker hands you an offering memorandum showing pro forma 10% cap rate, 25% annual return. But dig deeper. Those numbers assume you'll raise rents to the moon, slash expenses, and maintain 95% occupancy in a market that's currently at 80%. The pitfall here is falling in love with potential and forgetting reality. How do we overcome it? Ground yourself in actuals. What is the property's current cap rate on actual NOI? If it's, say, 5% cap on actuals and only becomes 10% if everything goes perfectly, recognize that the 5% is what you're buying today. Ask, why are they not achieving these pro forma rents now? What will it cost me to get there? Seasoned investors remind us, never rely too heavily on pro forma statements without verifying those numbers. If a seller is claiming the rent can be $1,000 a unit, but the actual leases are $700, find out why. Maybe the market can't support the $1,000 or requires $10,000 per unit in renovations. By verifying each assumption through market comps for rents, contractor bids for renovations, etc., you turn that rosy pro forma into a realistic plans. And if the plan doesn't hold water, walk away or offer a price that reflects current performance. Scenario number 2, the comps confusion. But the house next door sold for more. You're evaluating a small 5-unit apartment in a tertiary town. It's half empty with tired exterior. And the seller wants $300,000 because a similar 4-bedroom house down the block sold for that. So it's a good price. This is mixing residential comps with multifamily value, and it is a trap. A single family or 4-unit might sell to an owner-occupant at a retail price, whereas a 5-unit is an investment value on income. Pitfall: overpaying by using the wrong valuation method. How to overcome it? Shift to the income thinking. Calculate the current NOI of that 5-unit, and if rents are low and vacancies high, the value is likely far less than what a freestanding house might fetch. Explain that to the seller or to yourself that the investment properties are valued based on income they produce. You might even cite that the appraisers won't use a house comp for a 5-unit. They're going to use the income approach with cap rates. If the seller still insists on a price based on non-comparable sales, that is a red flag. Stick to your numbers. This scenario is common in tertiary markets where there aren't many apartment sales. A seller might latch onto any high sale nearby to justify their price. Don't fall for it. You make your money by buying based on actual income, not hope or irrelevant comps. Scenario 3, ignoring the expenses. The expenses are going to be the same, right? You've found a 20-unit building with decent income on paper. The seller shows a pro forma where expenses are magically low, even though it's a 40-year-old property. Now, what's the pitfall? Underestimating expenses and the capital expenditures will lead to overvaluing the property. When we start talking about Class C properties, especially those that are really old, they often come with very, very high maintenance and repair costs. It's one of the biggest risks when you start talking about Class C. And many new investors overlook things like the aging roof, old HVAC systems, or the need to resurface the parking lot. So how do we overcome this? We trust but verify every single expense line. Ask for the actual expense statements like utility bills, past CapEx history. If the seller provides an expense ratio far below typical, be skeptical. Industry insight, anything that's below 30 to 35% expense ratio, even when we're talking about nice properties, is questionable. And for Class C, expect a higher percentage. In fact, Class C deals often require substantial upfront costs to bring the property up to par. And they might not cash flow much until you make those improvements and stabilize that tenant base. So make sure you adjust the valuation for the real cost of what you're actually going to have to pay. A few other expenses to consider is property management or repairs that it likely were done by the actual owner. Often in a mom and pop scenario, they are handling the property management and repairs themselves. We do not want to base our purchase price on those scenarios. Scenario 4, fear of missing out. If I don't grab this now, I'll miss out. And in hot markets or tight inventory situations, you might feel pressure to pay more than your analysis says because everyone else is bidding, or the broker whispers this will be gone tomorrow. This fear of missing out can lead even the most sensible investors to bend their own rule. So what's the pitfall here? Letting emotions and competition drive you to overpay, effectively buying on pro forma because you assume the market will make it worth it eventually. This does not work out well. We've seen many times when investors accept very low cap rates or high prices today, banking on future growth. Essentially, they are speculators. Now, it may be true that in a rising market, you might get away with this. As an early stage investor in a tertiary market, you have to be very careful. Tertiary markets can have very slow growth and less liquidity. And if you've overpaid, you might be stuck with this property for a long time, or you may end up losing tons of money waiting for the market to bail you out. Stick to your criteria and remember your why. If your strategy calls for buying at an 8 cap on actuals, do not convince yourself to accept a 5 cap just because others are. Acknowledge the market context. In a hotter market, yes, you might pay somewhat more for the value add deal, but do so only after careful analysis and never beyond what your conservative pro forma can justify. Always be willing to walk away if it doesn't meet your number. One thing to consider, write down the worst case scenario for the deal. Lower rent growth, higher vacancy, all of those things that you need to consider and see if it still works out. If it only works out under perfect conditions, walk away. This is not where you want to be. Scenario 5, this town is booming. Make sure, no matter what, that if you hear that a town is booming, do not get stuck in this trap. Whenever you're investing in a market, it often means you're betting on the possibility of growth and that you may have found a hidden gem. But sometimes we can wear rose-colored glasses about a town. Perhaps the seller's pro forma numbers assume a rapid rent growth or occupancy increase just because the city announced a new factory or has some sort of hopeful news. The risk is overestimating how quickly the market is actually going to grow. These areas usually have a slower appreciation and rent growth compared to the big cities. And if you do need to sell or refinance, remember that there are fewer buyers and lenders comfortable with small markets. This can extremely hurt your value. So what's the pitfall here? Counting on an explosive market or explosive growth in a tertiary area. If a primary city is reasonably expected to grow by 5% a year, maybe you want to consider about half of that for a tertiary market. Check the actual local economic trends like population and job growth, major employees, and if pro forma assumes a 95% occupancy, but the town historically averages 88%, use that real figure. Look, buying at the right price sets the tone for your entire investment. If you follow one mantra from today, let it be, buy in actuals, not on promises. When you use real numbers as your guide, you protect yourself from overpaying and you set yourself up for positive cash flow and long-term success. We've shown how to navigate pro forma hype, differentiate residential versus multifamily valuations, and steer clear of pitfalls like optimistic fairy tales, comp confusion, expense amnesia, FOMO, tertiary market myths. Keep it upbeat. Every challenge that we discussed has a solution in your toolbox. Your action item. Take a deal you're currently looking at and practice this process. Dive into the actuals. Get the T12 or trailing 12 months financials and calculate what the price supports. Question for every single pro forma line. Is that rent increase justified? Are expenses too low to be true? If you find a gap, adjust the numbers to reality and see how the deal looks. This exercise will help sharpen your ability to separate fact from fluff. Finally, remember that smart investing is a marathon, not a sprint. By avoiding common buying pitfalls, you'll preserve your capital for truly great deals. The win here is confidence. Confidence that you walk away from a bad deal and pounce when good ones come, knowing exactly why it's a good one. Now go out there, analyze that next opportunity with clear eyes, and make your money on the buy, because that's how real estate wealth is built. That's it for today's episode of the Bounce Method podcast. If you got value from this, share it with a friend who's ready to stop playing small. And remember, wealth isn't built by watching, it's built by moving. So take what you learned, apply it, and keep the velocity of money working in your favor. Subscribe, leave a review, and stay in the loop at thebouncemethod.com. And until next time, keep bouncing forward.